Golden Rule Radio is brought to you by McAlvany ICA. ICA has been helping people take delivery of precious metals and find storage options for decades. They've also helped thousands of investors with their precious metals IRAs. Call ICA today for your free portfolio review at 800-525-9556 or download your free report online by clicking the link in the video description to learn how you can double your gold and silver ounces even within an IRA.
Welcome back to Golden Rule Radio. This week, we'll be taking a look at the gold price bouncing off of that sub-1700, 1670-ish Fibonacci range that we discussed last week. We'll also look at silver, which is also taking a brief hop back up towards $26, also coming into a short-term 618 fib. Platinum also taking a nice jump up in the platinum price, coming off a rising trend line. And finally, palladium, the one metal down, which does make sense given the ratios we've been discussing, down at the lower end of its rising compression dating back to last year. So as we continue to see some expected volatility in the precious metals market, that which we've been pointing out here for a while, following the great COVID run-up last year, Tori, what do you think we're going to see going forward in the gold price? I'm passing the charts across the table this week.
Miles, I lean on you for this so often, and Robert, who's not with us today. But from a technical standpoint, I really am optimistic that it can hold. I also, however, am a little bit pessimistic that we're going to see a whole bunch of activity in the short term. Even if the price holds, I feel like we should be prepared for some sideways movement here until we see further stimulus from the Fed, a rollover in the equities markets, a significant drop in the U.S. dollar. So until some of those fundamentals change, we've been waiting on the stimulus bill to create a little pop. And amazingly, the release of that or the passing of that actually coincided exactly with hitting your Fibonacci floor or support level. And so that's one reason that we've seen this pop, right? It's going to take more stimulus, more quantitative easing, more market stimulation for us to see some additional rally in the gold price in the short term. Otherwise, I'd say be prepared for a little bit of a slowdown, little sideways trading is my subjective sense of things.
Yeah, and I think that's a pretty reasonable subjective opinion of yours, which I would definitely second. Now, I tend to look at it more from the standpoint of the traders moving the market, not the news. And I know we've been saying that for years, but it is always fascinating to me how trader moving the market based on technical indicators somehow just magically, consistently coincides with news events happening at the same time. It's almost like free market hypothesis works, and people do, at least to a pretty large extent, factor in known information coming down the road. So seeing this gold pop back up, hot on the heels on the dollar rising, that's something Robert's been talking about for a while now, is this corrective push back up in the dollar, both from a fundamental standpoint as well as some of the technical levels we've looked at. Seeing the precious metals also rising alongside the dollar while the stock market is back up at the top end of its trading channel. So it's a good day to be American, I guess. We're getting free money out of the Fed and everything's up all at the same time. Does that continue? Does everything go up all the time, always?
No, it doesn't. Yeah, so the dollar index that you're alluding to actually finished strongly above 92. We're back below that now. So is it exhausting on this little rally? That has yet to play, and the pressure actually is on you to predict that from a chart analysis standpoint.
So with that dollar bounce we're seeing, last week we did talk about a number of these different transition levels for the dollar and how it's been tracking pretty closely to its expected pricing ranges. So it's not unexpected to see after taking that drop down into the 90s, we're now up to 92, and I know Robert and I have both been discussing pushing the dollar up as high as maybe 94, even in what's expected to be a inflationary bearish decline in the dollar, ultimately well down into the low 80s. And with that dollar rebound, it's not unsuspecting to see gold coming down. Now, we hit gold pretty hard last week. We looked at this rising trend line dating back to June of 2019 when we set the medium-term breakout C wave, heavy increase in gold going from 1,300 all the way up to 2,100 in a very short period of time. So we've come down and touched this rising trend line. We have a declining trend line in the short term. We've got multiple Fibonacci's levels all lining up here between about 1670 and 1685. So I just arbitrarily chose 1678 right smack dab in the middle. And lo and behold, on Monday, that's exactly what we saw. So it's not unsurprising to see the bounce in the gold price. But as I often say when we're talking about charts, charts have to confirm themselves. Now, unfortunately, for anybody who's waiting, gold's not going to confirm itself until it's been and spent some time up in the 1900 to 2000 range to confirm that we've started that next leg of the bull market. So there's certainly no time like the present to be increasing into your precious metals positions, especially those of you that follow the show and look for the stair steps that we try to provide for opportunities to dollar cost in while we get these corrective phases. So look for gold, as Tori was mentioning, to probably have some sideways movement here because this is a very powerful reversal level for gold. And while it could continue down, there is a solid argument that we may look back 6 months from now and say 1678 was the bottom. Now, again, silver, we've been talking about a while, not quite following the same pattern as gold because silver put its bottom in November and hasn't looked down there since. But silver did hit the lower end of this rising channel that it started in November and is setting another level to it now, I believe, with this reversal silver has had this past week. Silver hit its short-term 618 fib, good place for it to turn around. And the way silver has been marching upwards, it would not surprise me to see it go up and possibly even test that $30 range again if we don't get a very immediate break down in silver very soon. So if silver is going to continue down, it needs to do it in a very short period of time. Sideways movement generally signals continuation in whatever trend. If a price is reversing, if a price is going to continue down, if that top it put in back at the very beginning of 2021 was a reversal, then you would expect to see it continue down pretty shortly here. So silver, I expect to continue up, but we'll certainly have to see how it plays out over the next week. Platinum, similar to silver, hit the bottom end of its rising channel, has popped back up $100, is a little bit of a short-term shoulder where it could see some bearish resistance here at around 1200, but I think it can and should break through that fairly easily. And if platinum were to continue up, we're looking at another high for platinum pushing well above 1300 and looking back at, again, pricing from 5, 6, 7 years ago. Platinum is playing a very strong catch up to gold while still lagging behind. I think platinum still remains a necessary piece in a metals portfolio. And finally, the Dow Jones, while putting in another all-time high, it's done a lot of that lately, although slightly above the last one, going back to November of last year. Dollar continues to put in these all-time highs in a very, very tight trading range. I wouldn't be surprised to see the dollar actually turn down in the next day or two because the dollar is back at the top end of that trading range. It doesn't show any reason it should be breaking out. The only exception to that might be because of this COVID spending package. Never surprises me when some government spending package, some of that money makes its way to Wall Street. So it is possible we could actually see a breakout up in the Dow. And I've been saying for the last couple of years, there's no reason in an inflationary depression that you don't see the Dow go to 50,000. It's not so much about how many dollars is the Dow Jones worth, but what does that actually mean? The Dow at 50,000 and gas prices at $5 or $6, you haven't really made anything. So this week on Golden Rule Radio, somehow after 3 years, we're doing something we've never done before. And that's having the boss man, Dave McAlvany, join us. Dave, it's good to have you. We get to listen to you every week on the weekly commentary with Kevin. And I don't know how we haven't walked across the hallway and said, hey, Dave, come join us before. But following a conversation you and I had yesterday, I was driving to work this morning thinking to myself, we get this question a lot, and I thought it'd be worth, time permitting, having you join Tori and I today just to talk a little bit more about the broader gold and commodity market. So, Dave, thanks for coming.
Hey, listen, I'm grateful to be here. You guys are doing a great job with Golden Rule Radio, and I'm glad I can be in the conversation today.
So, yesterday, Dave, you and I were talking a little bit from a money management, wealth management standpoint, because you wear a couple hats here at the McAlvany Financial Group. One included over on our wealth management side, looking not just at the price movement of the precious metal commodity itself, but specifically some of the companies involved in the production and distribution of precious metals. And one of the conversations I thought was worth sharing was some of the disconnect we're seeing between the price of precious metals, the quantity of production that was produced, which is something you brought up yesterday, just the amount of product coming out of the ground in 2020, despite some of the COVID shutdowns and slowdowns, and then how that price is responding to both the other commodities coming up, like what's going on in copper and oil, and how gold's responding there. And then a bit of a disconnect between the gold price moving and the share price of what some of these production companies are doing. So looking at the broader gold market as a whole, not just finished investment property, but the whole market as a whole, what do you think we're seeing in the gold price going forward?
Very notable last week was a divergence between the performance of the miners and the underlying commodity. So gold sold off, and the miners actually finished on a positive note, up almost 5% for the week. That kind of divergence may, in fact, be a signal that we're getting to a place where bullion has done its best to plumb the depths and is in a position to move higher. And time will tell. I mean, obviously, we don't have a crystal ball, but you look for divergences, and those can oftentimes be advantageous points to be adding to positions. So on the asset management side, that might mean for us adding to particular companies we already have exposure to and want to increase exposure to. On the precious metal side, it might be looking at the physical commodity and saying, yeah, in fact, we're seeing some positive signals, even though price action in the commodity hasn't been great in recent weeks. In fact, we're seeing these divergences stack up in favor of doing something positive. Buy. That would be the action to take.
In that regard, it has been great in the last couple of weeks, right? Opportunity to add to ounces. So you're not predicting something necessarily immediately short term. This is more, as Miles alluded to, a macro signal.
Yeah, I think so. And I think one of the things that's been very impressive looking at the individual companies, both year-end and fourth quarter performance, is they're doing really well, applying capital disciplines that they didn't have last time we got to 2000. Roll the clock back 10 years to the year 2011, and you had mining executives who were just out of their mind enthusiastic about the gold price, and they weren't managing their business as well. They were paying too much for new assets, and they weren't keeping a cap on costs. And so even though the price of gold was high, they weren't making very much money. And the odd thing is, the market rewarded those companies in a massive way. You look at something like the Gold Bugs Index today, HUI. It's about half the level it was in 2011, and yet these companies are making more money today than they were back then. So from a value standpoint, you could argue that there's something that the market's overlooking. In a world that is overpriced, thinking of the Dow, the S&P, the NASDAQ, we could talk about valuations. Yeah, everything. There are some pockets of value. Last year, oil and oil infrastructure opened up some interesting pockets of value, just given what COVID did and the way the market has looked at those kinds of assets. This, I think, is going to be a really interesting year. We've got more stimulus coming than we know what to do with. 1.9 trillion already in the Financial Times this week. What's next on tap? Probably $2 trillion stimulus package is focused on infrastructure. And then there's a whole nother thing. I haven't wrapped my mind around this one, but an almost $2 trillion stimulus package for childcare and green energy. And if you look at the backdrop, the kind of deficit spending we're embracing and the potential implications that has for destabilizing the bond market, we're talking about inflationary trends ultimately, which would be very destabilizing for the bond market. What implications are there from that into the broader financial markets? This is a really fascinating market to be in. In that kind of a market environment, do I like owning physical metals? Absolutely. And is there an interesting growth proposition if we're right, and gold firms here moves higher? You're talking about a lot of companies that actually they're overlooked, they're underappreciated.
So, Dave, given your explanation of the activities of top-level executives in some of these commodity companies, where you tend to assume they're traditionally more conservative, just as an argument, Guys bringing copper out of the ground are obviously going to be slightly more conservative mindseted people than, say, guys building townhouses in 2006, booming real estate market. So given the expectation of a slightly more conservative move outside of just market mania that occurs when the price of the commodity you deal in is skyrocketing, do you see them taking any kind of activity in preparation for this going forward? And what I'm asking, I guess more specifically, is one of the things you and I talked about yesterday was a pretty dramatic increase in production numbers going forward in 2020. But on the flip side of that, one thing Tori and Robert and I have talked about for the last couple weeks is this premium disconnect between, say, the spot price of gold and what you can actually buy a coin in a bar for. So it feels like there's actually a shortage of available physical product, which makes sense in a rising environment when you have increased demand. But it also sounds like there might even be some increased production in anticipation of rising demand going forward. So do you feel like some of these mining companies are feeling a bit of supply versus demand squeeze in the market?
I look at the product bottleneck as the primary issue, where if you look at particular entities like the Royal Canadian Mint or the U.S. Mint or the South African Mint, the Rand Refinery, these groups aren't necessarily geared towards maximizing profit. They're not going to run extra shifts when demand increases. And so you can end up with a supply bottleneck. You just don't have enough supply to meet demand. Meanwhile, the miners, if they are bringing more product to market, it's going to go from a Doré bar to either a kilo bar or a 400-ounce good delivery bar. And the average investor is not buying $700,000 bar, or in the case of a kilo bar, $55,000, $56,000 bar. So I don't think the new supply is going to make it to the hands of the average investor. Institutions will happily have access to more gold or silver, but you're going to continue to see these product premiums, particularly on the smaller products. And then the closer you can march towards large format products, all of a sudden those premiums don't exist because they're readily available. And so I think it's very important to just make that distinction, that if you're going to a local pawn shop or coin shop or whatever, and you want to buy $500 worth of silver, you will be shocked by how limited the supply is and how high the price is for that particular product. But if you wanted $500,000 worth of silver and you're happy to buy 1,000-ounce silver bars, there is no line, there is no premium, you can have all you want and more. And there is plenty of supply coming from the producers. A lot of these guys are ramping up production. Looking at some of the Mexican producers, one in particular that brings 53 million ounces a year, one of the largest producers in the world, they're slotted over the next 3 years to be increasing production to 71 million ounces per year. That's great, but how much of that gets turned into Libertads or American Eagles or Maple Leafs?
Yeah, not as many. And the 1,000-ounce bars, the large kilo bars, we use a ton of those in IRAs, in storage accounts. It's nothing that the average investor certainly is going to take delivery of. You can. We discourage it. But it is a very effective way of avoiding the premiums right now. And so circling back around to the conversation that you had on the executives or the producers in general, you've mentioned the 1,000-ounce silver bar. Are you seeing a similar dynamic? You've talked a lot about gold in the first part of the show. Do you see the white metals being as attractive, either from an individual company standpoint?
More attractive.
Even more attractive.
More attractive because you're talking about micro markets. I mean, if you looked at the scale of gold versus silver versus platinum, you're shrinking each time you move from one of those categories to another to a smaller and smaller market. So it doesn't take hardly any demand to move those markets. As it turns out, you've got a double benefit with the white metals. Not only is there industrial uses for them, whereas gold, there's hardly any industrial use at all. But with the white metals, you've got that as a demand issue. You also have investor demand aware that these are metals that are hypersensitive to inflation. They're also hypersensitive to deflation. So to the degree that you see a deflationary trend, you will see the white metals suffer greatly. And that's where, looking at that macro picture, if in fact we have more inflation coming, then the white metals are likely to outperform gold. Again, a lot of people look at metals and say, well, I want to own something that's an insurance policy. Well, that's great. Gold's good for either inflation or deflation. But to the degree that you're gearing for growth, then the white metals have a play. And I think in this cycle, they're going to have a huge play.
Dave, thanks for joining us this week. I think as this bull market marches on and we see these corrections over time, being able to bring in a look at the market as a whole outside of what we focus on Golden Rule Radio and then what you guys focus on the weekly commentary, hopefully we can merge some of that conversation going forward because I think people are curious and want to be able to see the bigger picture. So thanks for taking time out of the day.
Glad to be here. Let's not wait 3 years.
Okay. Sorry, boss.
So thanks for the great technical analysis. As always, just a couple of fundamental things to point out. Next week, we do finally have an FOMC meeting.
It's about time.
I know. I mean, there was one immediately after the inauguration. Doesn't really count, right? We should garner a lot of information next Wednesday in terms of what David has discussed today and some indicators as far as to what the Federal Reserve's outlook is for inflation. Keep in mind, last week, we surpassed the 28 trillion national debt mark, and now we're looking at equities at all-time highs, and as David alluded to, everything's expensive, but we're looking for value. So that's going to wrap up this week's Golden Rule Radio.
So thanks again for joining us this week at Golden Rule Radio and our special guest, David McAlvany. If you liked what you heard, click the subscribe button, ring the bell. Make sure to catch Dave McAlvany's weekly show, the McAlvany Weekly Commentary, on iTunes and here on YouTube. You can find more info at McAlvany.com, on Twitter at ICA Gold, or on Facebook at McAlvany Financial. And if you have any questions about your personal precious metals portfolio, give one of the advisors at McAlvany ICA a call at 1-800-525-9556. Thanks for listening and have a great week.